option out of the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, 600. Today, 100, and we see it going down to 50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everyone. It is Wednesday, March 1st, 2023. Carol Masser, my co-host Tim, as you know, is off on leave. Bloomberg Quick Take correspondent Maddie Mills back in the house. And I feel like it's a broken record again because it's kind of a trade off of inflation concerns and a hawkish Fed. It's playing out today.
And then we got the Europe conversation, right? Germany, France, Spain,
Huge. I mean, talk about hot inflation prints. We're going to get into it. Also ahead, we've got the Bloomberg exclusive, thanks to our Eric Schatzker, on a Bridgewater Associates post-Ray Dalio era. An incredible story. Eric has talked to Ray many times over the years, but what is the firm going forward? We're going to get into it.
And then also at Bloomberg, we always have the best interviews. We've got Chevron CEO Mike Wirth live with Alex Steele in our 4 p.m. hour coming up as well.
Maddie, we're also going to tell everybody about the Fed's best bet for a soft landing, plus a story you highlighted earlier on our planning call about car debt in the U.S. continuing to pile up.
I love a good consumer trauma story, so we're going to get some advice from a personal finance reporter down in D.C. on that. And the satellite hack that everyone is finally talking about, we're going to get all of that later today.
All right, we got a packed show on this Wednesday. First up, though, let's talk about the trade. We're bouncing around on the equity side of things. For more, here's Charlie Pellet.
All right, thank you very much. And in one word, negative. Red, Dow, S&P, NASDAQ, all declining right now after earlier gains. We got the S&P down 20 now, drop there of 0.5%. Stocks and bonds are dropping as investors adjust their outlook on peak rates after a slew of data highlighted persistent inflationary pressures, and Fed officials continue to be hawkish. So here's where we stand with the S&P down 19, down 0.5, the Dow down 54 now, drop there of 0.2%. NASDAQ down 69, a drop there of 0.6%. 10-year yield, 10-year right now, 4.00%. We've got the 2-year, 4.89%, and spot gold up 0.6%, 18.38 the ounce. West Texas Intermediate crude up 0.5%, 77.44 a barrel. Kate Faddis is senior portfolio manager at Fernwood Investment Management, and this morning she told us, do not bet against the Fed.
I think the Fed is quite earnest in what it's trying to do, which is to crush inflation. An ounce of prevention is better than a pound of cure. So that's what the Fed is trying to do. So whether they get it right this time, they get it wrong, I think they're very clear. They want to see inflation down at 2%, maybe 3%. And until they get there, they are going to do what it takes.
Kohl's reported fourth quarter sales that fell short of analyst estimates, and it issued a downbeat forecast for the full year, pointing to weakness ahead for the retailer, which has been struggling to attract inflation-strapped shoppers amid management changes. And among retailers, Kohl's shares down now by about 3.5%. Tesla holding its investor day today. We've got Tesla shares down now by 1.9%. Again, recapping stocks lower. S&P down 0.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Wednesday. Let's get to the Market Drivers Report. Let's set your Business Week agenda on this Wednesday, first day of March. Kriti Gupta, anchor and markets correspondent at Bloomberg, just coming off of Bloomberg TV. She's in our Bloomberg Interactive Broker studio. So, too, is Abigail Doolittle, markets reporter at Bloomberg News, as we said, both in studio. Kriti, kick it off for us. What is, if you had to, in a sentence, say the most important thing in terms of today's trade today, what would you say?
10-year yield at 4%. And I think that's a really, it hit. It just hit. And I'm so glad, because it was $3.99 when I walked into the studio. It just hit 4%. This is really important. Round numbers completely driving the bond market today, which in turn is going to be driving the equity market. Look, you're looking at the S&P 500 down about 0.6%. That, to me, does not scream fundamental narrative. We don't know if it's the Fed. We don't know if it's the earnings story. We don't really know what's driving the equity market. And I think Stuart Kaiser over at Citigroup said it best. He said, look, the best thing for the equity market is clarity. And right now, there is none. And to me, I think that's why the bond market is a little bit better, because it is giving you clarity. The Fed pricing is really important. 5.5% peak policy rate for the Federal Reserve, now priced in, not for July, but for September. And the message there is higher for longer is what's going to stick. And that's what the bond market is looking at. 4%.
Wait, did you just say that they're now pricing in moves for
September?
Wow. Okay.
Which is interesting, because remember, September was supposed to be when Fed cuts were supposed to happen.
Right.
And now it's the peak, the Fed peak. So it's an interesting turn of events.
The only thing I would say, just real quickly, is that things can change, and we know that.
Totally.
Right? The Fed
market
is data dependent. We'll get that March dot plot, which Kashkari earlier said, that's what I'm really focusing on. That's important. But nonetheless, we know things can change depending on the flow of data.
Yeah, it's absolutely critical to keep looking at that eco data. Abigail, what's the equity side doing?
Well, it is down, as Kriti was mentioning, and I completely agree with Kriti that today the biggest story, it's yields. The 10-year yield at 4%, the round number, I don't know that that's the biggest biggest deal. To me, actually, technically, it's really starting to break out, and that suggests exactly what Kriti was saying, that bond investors are finally come to terms with what the Fed has said all along, that they are raising rates. They're not going away. They're not cutting. They're not, that they said, Fed Chair Jay Powell last year very clearly said that they're willing to sacrifice the economy to fight inflation. And now we have what seems to be a little bit more stubborn inflation. So stocks, though, relative to this are sort of interesting. So, the super growthy momentum China tech stocks, we actually have those up 2.8% because they've been sliding more recently. Up until just recently, the NASDAQ had been higher. Not so long ago, what I'm trying to say is we had mixed markets. So now stocks are really sensitive to the downside, where we have the S&P 500 down 0.5%. I wouldn't be surprised to see this market close either up and mixed or sharply lower, quite frankly. What we are doing technically, though, is we're right on that 200-day moving average, or pretty close to it. This is the second test most recently. It tells you that the buyers really have to stick to their convictions if they're going to buy this. It looks good to me, but who knows?
Because there's been the stories that are saying that technically we've been holding up on the S&P.
We certainly have been. I mean, we are holding that 200-day moving average. I'm looking at it right now like a glove. I mean, last week we touched down on it. Today we're touching down on it. I was just trying to chart out a couple different ranges. There's so many different ranges over the last year, and it's tough to know which one is going to win out. My gut is that this market is sideways to up over the course of the year, and possibly very up. But on a day like today where it's just kind of messy. Something also that was interesting earlier, you had the VIX, that volatility index, down when the S&P 500 was down about 0.6%. So investors are a little bit confused.
Can I just say, I don't get the VIX. Yesterday there was a ton of volatility and it was down.
Yeah.
So I don't know.
The disconnect. And some might say, well, that's people using those daily options because they don't go into the VIX.
Okay, got it.
What would you say is the biggest macro factor today? Is it Europe? Is it China? Is it data here in the U.S.?
It's yields.
Yes.
Yeah.
It's yields.
Yeah.
Which kind of incorporates all of that.
Yeah.
Well,
I don't know. Maybe Kriti sees something else.
No, I totally agree. It's an 8 basis point move, and when you look at the bond market for the 10-year yield, that's the poster child I'm looking at. The move started overnight. Started in Europe. It's that inflationary story we've been talking about for a couple of days now, and then it's the ISM data. That was like the extra boost that took it from, looking at the chart now, 394 to 399, and then 4% eventually. So it was the ISM data that came in way stronger than everyone expected.
Yeah. The thing I would say is that I feel like there's a lot of conversation around, like, if the Fed is saying, rates are going to 5 or 6 or whatever percent, like we know they're going higher, we're not there yet, right? And so the bond market has to play catch up, correct? And that's what everybody says, right? The market has to play catch up to what the Fed's going to do.
You're exactly correct. And last year they were caught offside so many times, and now really coming, facing, I'm so bad with these things, but facing the music, is that the same?
Yeah, facing the music. No, that's fair, right? Like they fought it. You saw how traders fighting it for such a big time. And I do feel like over the last couple of weeks, it's like people got religion when it comes to Fed policy.
Yes.
But I also wonder how much of this, look, they're trying to get ahead of it in that the timing is different, right? They're now pricing in that peak in September when they were pricing it in July. And I think what's been the game changer here is the cuts that a lot of economists have said aren't coming. The market, equities, and bond investors alike were like, this is going to happen. They're going to cut in September. That getting pushed out into 2024 is I think, changing the game. And I don't necessarily think they misinterpreted, I got to disagree with Abby here, I don't think they misinterpreted the Fed. I don't think it's that they're not listening to the Fed. I think they're trying to get ahead of the cuts first, which is a different dynamic.
That's interesting. I don't know if I agree with that. I think that, my view is more that the Fed has been so accommodative for so long, that Fed puts in place, everybody thought that if the Fed were to all of a sudden, if the economy were to shrink in any way, the Fed was going to blink, and instead I don't think that they're blinking. That's just my view. That's completely valid for us to have two different views on it.
But that's part what we have to figure out, right? But this is what we have to figure out. Investors, right, forward looking, like when is the point where we think the Fed has come to an end and you start to trade on that? And I feel like we've kind of walked back from that.
Yes, I think
we're not quite sure when that end point is.
100% agree with that, Carol.
All right. Last point.
I was just going to say, I think Europe is also playing a bigger role than
Can we just talk about that
expected.
German inflation? I was listening to surveillance this morning. That was massive.
It was massive. And remember, it comes off the heels of France and Spain, and it kind of went in these little baby steps. Spain first, which was kind of the baby Spanish economy.
6.2, right?
Right. Yeah. And then 7.2 in France, which is when you're like, hold on a second, manufacturing is a bigger deal. And then from German, like the manufacturing hub.
Yeah.
That's a whole nother world.
All right. Well, great setup for us guys on this Wednesday. Kriti Gupta, anchor and markets correspondent, along with Abigail Doolittle, our markets reporter here at Bloomberg News. Well, we know the financial world continues to evolve, and one thing we have seen over the last couple of years is a string of iconic firms run by their iconic founders figuring out succession plans and the way forward. Among those firms, Bridgewater, whose billionaire founder Ray Dalio handed off control 5 months ago. In a Bloomberg exclusive and the most read story on the Bloomberg today, Bloomberg News editor-at-large and new economy editorial director Eric Schatzker joining us on the major revamp of the world's largest hedge fund. He joins us in our Bloomberg Interactive Brokers studio. First of all, great story, great reporting. This is someone you know well. Just remind, you've had many conversations, kind of put Ray Dalio in kind of his place when it comes to the financial community, and something that our investors know a lot about.
Ray is a hedge fund investing legend, you can call master of the universe in Wall Street terms. Yeah. He built the world's largest hedge fund at Bridgewater Associates and amassed more money in hedge fund strategies than anybody ever had and anybody ever has to date. At its peak, Bridgewater had more than $150 billion under management. And one of the important things, undercurrents to this story, is that in the course of amassing all those assets, Bridgewater, under Ray's leadership, kind of defied gravity, because the conventional wisdom in hedge funds is that each strategy has a natural size cap to it. There are only so many opportunities that any one firm can harvest. Mm-hmm. And so if you try to run too much money, you're going to erode your returns. Now, this law didn't seem to apply to Bridgewater for a long time. And then in the 2010s, they had a prolonged period of underperformance and really had to take a hard look at themselves in the mirror and ask, what was wrong? What are we not doing right? They started to take some steps to reconcile or resolve those issues while Ray was still there a couple of years ago. But now that he's gone, the new generation of leadership has the freedom to go much further, and they are.
And how is that going for them?
Well, it's early days yet. This was just announced today. In fact, some people at Bridgewater would say, thank goodness we're actually starting. Mm-hmm. There was a sense inside the firm that while Ray was still the boss, and the controlling shareholder, some of these changes were difficult to implement. I'm not sure I would quite go so far as to say he was resistant to them, but now you have younger people running the firm who have ideas of their own and who want to implement them. So it will take some time to see if this idea of capping their flagship hedge fund strategy, Pure Alpha, will help to deliver better returns in that strategy. What it will mean practically is that clients who want more Pure Alpha or who aren't in that strategy and want access to it may not get it. And
so institutional clients are going to have to be competing for that.
Mm-hmm. More so than they have been. That's right. There's always been a ceiling, but now the ceiling is much lower on how much they're willing to manage. The maximum at one point was about $100 billion, and it's going to be 20 to 30% less than that going forward.
So more money into talent in AI, machine learning, expanding in Asia.
Yeah, this is the flip side of the coin.
Talk to us a little bit about these strategies and what strikes you the most in terms of what this means for Bridgewater going forward and its new CEO.
As they cap the opportunity set in Pure Alpha, they're cutting some jobs. They no longer need as many people to support that strategy. And they're reallocating those resources to these new initiatives. One of those initiatives is growing the firm's international footprint in Asia in particular. Mm-hmm. Another is building out their equities business. Mm-hmm. A third is sustainability, and a fourth, as you mentioned, is AI and machine learning. Bridgewater, like many firms in the hedge fund industry, has been experimenting with AI and machine learning for quite some time. To date, nobody has really figured out a way to master those technologies in a manner, let's say, that truly supersedes human decision-making. Mm-hmm. That's the dream, that you'll be able to program a machine and the machine will be able to invest better than the human.
Right.
It hasn't happened yet. And what this tells you is that Bridgewater, by putting this effort underneath one of the co-chief investment officers, Greg Jensen, is really getting serious about trying to reach that holy grail, let's call it, or find that holy grail.
It feels like they're kind of investing in the ideas of that younger cohort of investors. Is that how you would describe it?
I think the younger people who are now running the firm in their 30s and 40s, for the most part, recognize that this is the future and that they need to chase the future as hard as possible if they want to get there first. One of the things to keep in mind about technologies like generative AI or quantum computing, which is around the corner but not quite here yet, is that it might be winner take all. If you get there first, you open up such a lead over your competition that they may never catch up.
Yeah, it's kind of fascinating. What about, Ray Dalio?
Bridgewater, it's interesting. Bridgewater has written about this to its clients, and they call those types of technologies force multiplier technologies.
Well, think about it, right? If they get it right, you can think about the returns that could be potentially off of that. Hey, listen, got about a minute left. I think about Ray Dalio, and I do think about, for many years, his outperformance and how well he did with Bridgewater. But he also talked about society at large. Is that still a part of the fabric of Bridgewater? Or is that
Ray cared about society. His concern for society and his concern that we are able to get along with one another and we don't devolve into partisan bickering and the potentially terrible consequences that could come out of it were unique to Ray himself, his point of view. But the people who run Bridgewater now have their own ethos. What they did say, what Nir Bardea, the new CEO, said to me is, for us, it's not ideological. We are where we need to be. For example, we're in China because our clients want us to be there, and we'll be there so long as we can. But it's not about ideology.
I love to, and we're running out of time, but this whole idea of his contribution, what he calls a flywheel, and that's that whole idea of like chasing new talent, right? New ideas.
That's right, and it'll become this virtuous circle. So.
Don't kill me, but it almost sounds a little Cathie Wood-like.
I don't think they crave that comparison one little bit.
Okay.
Yeah, I just feel like maybe the young people are getting there. I don't know.
Great story, again.
Thank you, Carol.
And it is the most read on the Bloomberg in the past 8 hours. Eric Schatzker, editor-at-large. He's editorial director for Bloomberg New Economy, joining us in studio. Check it out at Bloomberg.com and, of course, on the Bloomberg terminal. You are listening and watching Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. Red on the screen right now with the Dow, the S&P, and NASDAQ all declining. S&P down 21, drop there of 0.5%. The Dow down 62, drop there of 0.2%. NASDAQ is down 76, a decline of 0.7%. The 10-year yield right now 3.99%, with the 2-year 4.89%. Spot gold is up 0.6%. $18.37 the ounce, and West Texas Intermediate crude oil up 0.6%, $75.54 a barrel on WTI. Stocks and bonds are dropping as investors adjust their outlook on peak rates after a slew of data highlighted persistent inflationary pressures, and Fed officials continue to be hawkish. Again, the 10-year 3.99%, stocks lower, S&P down 22, down now by 0.6%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Maddie Mills here on Bloomberg Business Week. Next half hour, we're going to dig into a couple of stories in the upcoming new issue of Bloomberg Business Week that really address two of our biggest global stresses. We're talking about China and the war in Ukraine. This new issue of Business Week, by the way, it'll be on newsstands tomorrow, online already at Bloomberg.com/businessweek, and already on the Bloomberg terminal.
First up, we are going to talk about a story that is critical to us, like you were saying, Carol, China, and specifically U.S. policy and a key Biden administration official driving a lot of that policy. So we're going to bring in Bloomberg News reporter Eric Martin. He covers trade and more with us on the phone from our Washington, D.C. bureau. Eric, great to speak with you, as always. Tell us a little bit about Gina Raimondo and why she is so critical to the Biden administration's moves here.
Absolutely. Well, Commerce Secretary Raimondo is somebody who is at the center of the China policy, both in terms of the defensive of preventing key technologies such as advanced computer chips from getting into Chinese hands in a way that particularly that could be used for military equipment or surveillance or other human rights abuses, but also on the offensive strategy, which is to build more computer chips in the U.S. The Commerce Department this week laying out rules for $39 billion in funding for semiconductor makers, all of the hoops that they'll need to jump through in order to get this money, but looking to build at least 2 clusters of chip production within the U.S. In the coming years, and to really return this manufacturing to the U.S. This is something that there used to be near 40% of chips made in the U.S. These days it's down to about 12%. And so this is something that has been identified as by the administration as key to competing not only with China, but also with Taiwan, with South Korea, and to friendshoring, to bringing these national security critical technologies back to the U.S.
Hey, Eric, Commerce Department, as you and Jenny Leonard report, you know, kind of a sleepy little office. They put a lot of economic data out and all that good stuff. As you guys write, it's not a sought-after perch for those looking to make their mark in Washington, yet she certainly is being thrust into some of what are the biggest issues when it comes to the Biden administration. As you mentioned, China, semiconductors. She's dealing with TikTok. Tell us a little bit about this individual, because I love the way your story starts, that she seems to be all in when it comes to everything concerning her job.
Absolutely. Well, she is former governor of Rhode Island, also spent a decade as a venture capitalist, a Rhodes Scholar. She is a lawyer by training and by education. And, you know, she's somebody who really, when you talk to people in the business community, she really gets down to, you know, to business and understands the needs of businesses. That she's somebody from, based on her background, she understands the kind of red tape that they need to deal with, seen as being non-ideological, you know, like respect on both sides of the aisle, although Republicans have also been clear about their intention to provide, a lot of oversight, given the amount of the tens of billions of dollars in taxpayer money that are going to be awarded here. But she's somebody who is really seen as having re-energized the Commerce Department, taken over from a predecessor in the Trump administration, who was much older, who reportedly was someone who at times would fall asleep in meetings, and this is something that definitely nobody would ever be concerned about Secretary Raimondo.
Yeah, I mean, I love, Eric, the color that you guys have in your story, from the naps that her predecessor took to the fact that she and her staff celebrated the win on the CHIPS Act by having a lot of potato chips in the office. It's just great how you were able to get all of that into this piece. I wonder, on the CHIPS Act, though, if you can talk a little bit about how she managed to steer that. And more specifically, we recently got this news from the Biden administration kind of attaching some strings to those who might be seeking some of that nearly $40 billion in funding available from the CHIPS Act. Can you talk about whether those strings impact her success on getting that through at all?
Well, certainly there was a push by Congress to make sure that certain things, particularly Senator Elizabeth Warren wanted to make sure that money from the CHIPS Act would not be used, for example, for stock buybacks by companies, wanting to make sure that it really, goes into projects that are going to strengthen national security, but also to result in factories actually being built. We've seen some examples in the recent, not so distant past of U.S. industrial policy or boosting of investment companies like Foxconn, which was supposed to have thousands of jobs, almost around 10,000 jobs in Wisconsin, and has wound up with only about 1,000. This was a company that was boosted, Taiwanese company boosted by the Trump administration. Also about a decade ago, the example of solar company Solyndra that went bankrupt despite receiving almost $500 million in government funding. And so definitely a lot of guardrails being put on this, and a lot of attention being put on this. And so that also made for a more complicated negotiation in Congress last year. But members of Secretary Raimondo's staff describe her as just, really tireless in terms of her work, and somebody who really drives staff. Some staff members mentioned, always when she would get on a flight, kind of fearing when she would land because they knew there would be a barrage of emails about whatever they were working on. And, so...
We've all been there.
Her hard-charging personality is definitely a big part of the story of passage.
Well, what do we know internally? I don't know what the, scuttlebutt is, maybe inside the White House, because with her dealing with such important key issues of the Biden administration makes us wonder, and you guys write about it and address about it, some of the speculation about whether or not she could be on the ticket with President Joe Biden come the next presidential election.
Well, it certainly is something that swirling speculation, within Washington, more so last year, regarding whether Secretary Yellen would leave Treasury after the midterms and whether Raimondo might replace her. But Secretary Raimondo really tries to damp down the speculation and say that she has a lot to be working on right now and is very focused on the tasks before her.
So that's a no.
Well, when she's asked about, whether she thinks she could be president, she's, whether she thinks she couldn't be president, she says, I didn't say that, but we're focused on the task of the moment.
Well, and that task for her, as going back to kind of an ending where we started with China, that's the big focus for her. I wonder if you can talk about the TikTok element of this as well. What do we know about her thinking on what the U.S. should do when it comes to banning TikTok or finding alternative methods for dealing with the TikTok situation?
Sure. Well, she's talked about the idea that you can't legislate for just one company, and balancing multiple considerations here. One being freedom of speech, certainly, but always placing national security and data security at the center of conversations on a wide range of topics. So this is something that the Commerce Department combined with the White House and National Security Council, we know that they're taking a hard look at what to do here.
I love the way you guys wrap up this story, Eric, and that is asking her, which, we often ask leaders this, what keeps you up at night? Can you just kind of share that with our audience?
Sure. Well, it was my colleague Jenny who sat down with her, and it was really, underlining that when leaders are boxed into corners, they sometimes make bad decisions, or when they're having a tough time, in terms of the situations and the panorama facing them, and that China is having a tough time right now, given the way that various factors have played out for China, and so that being something, that concerns her as to what decisions leadership might take, if they feel that they're cornered.
I love stories like this, just giving you really some insight into certainly one of the leaders of the United States, and I was just saying global leaders, like as we think about kind of the specifics and what makes somebody tick. Eric, thank you so much. Eric Martin, reporter at Bloomberg News, on the phone from our Washington, D.C. bureau. But I think about the flurry of headlines today, Maddie, on China, like trying to make sense of it.
So much is going on, and I feel like when we were covering the China reopening, it was such a question mark of whether or not that was going to stick, and it just feels like the economic impact we're seeing out of the region, the cat is out of the bag on the China story, and it's not going away anytime soon. So really good to get those insights from Eric. He always has the best stories of folks in DC and some of the kind of insights behind, like the potato chip celebration. That's just hilarious. That is so good.
How it all comes together, really comes together.
Yeah, exactly.
All right, you are listening and watching Bloomberg Business Week.
And we're going to get a check on the latest world in national news with Nancy Lyons in the Bloomberg 99.1 newsroom in DC. Hey, Nance.
Thanks, Madison. You've been talking about China. Secretary of State Antony Blinken says he is not planning to meet with his Chinese or Russian counterparts at the upcoming G20 meetings in India. Relations remain frayed over Vladimir Putin's war in Ukraine and U.S. allegations that Beijing may be offering Moscow weapons or other lethal aid. But Blinken did tell reporters in Uzbekistan he may participate in group sessions at the meeting alongside diplomats from those countries. Lawmakers in the House have signed off on several China-related bills, a sign of strained relations between Washington and Beijing, and one of the few things on which Republicans and Democrats can agree.
Most of the bills have strong bipartisan support, including pressuring the IMF for more transparency from China on its exchange rate, requiring Treasury to issue a report on economic risks from the Chinese financial sector, and directing U.S. officials to support Taiwan membership in the IMF. One bill allows the administration to ban TikTok in the U.S. under certain conditions, and lawmakers will vote to hold China accountable for the surveillance balloon that drifted over the U.S. last month. In Washington, I'm Amy Morris, Bloomberg Radio.
Closing arguments are underway in the double murder trial of former South Carolina attorney Alec Murdaugh. Prosecutor Creighton Waters told jurors today only Murdaugh had the motive, opportunity, and means to kill his wife and son.
Sometimes people in common discussions will say, oh, the case is just circumstantial. But the law says that doesn't matter. The circumstantial evidence can be just as good as direct evidence. It is just as good. It makes no distinction between that, and the judge will charge you on that.
Waters says financial pressures were squeezing Murdaugh, and that led him to commit the crime. Defense attorneys have argued there may have been a second person responsible. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Tech tumbles, 241 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. Stocks are being dragged down by technology as yields stay higher. 10-year Treasury topping the closely watched 4% level. Right now we have got the 10-year 3.99%. Equities lower across the board with the S&P down 24 right now. That is a drop of 0.6%. The Dow down 73, down 0.2%. The NASDAQ Composite Index down now by about 0.7%. And again, the S&P down by about 0.6%. The 2-year yield 4.88%. Spot gold up 0.6%. $18.38 the ounce, while West Texas Intermediate crude up 0.8%, $77.67 a barrel. Stocks and bonds are dropping as investors adjust their outlook on peak rates after a slew of data highlighted persistent inflationary pressures. As for the market backdrop, Mona Mahajan is senior investment strategist at Edward Jones.
As we get through this year, we need to see a couple of things before we can kind of revisit that recovery playbook or that cyclical playbook. We would still need to see, one, of course, inflation move meaningfully lower. Two, we'd like to see the Fed actually step to the sidelines at some point, probably middle of this year. And then three, we are starting to see earnings being revised meaningfully lower at this point for 2023. We haven't seen that bottom yet.
Novavax shares are plunging now by 27%, putting the COVID-19 vaccine maker on track for its worst day in more than 2 months. Fourth quarter revenue missed analyst estimates. The firm said there is substantial doubt over its future. Again, Novavax plunging by 27%. HP maintaining its annual guidance for cash flow, even as it grapples with slumping PC demand, and a sign it does expect a rebound later on this year. Shares of Hewlett-Packard HP Inc. down now by 2.2%. Recapping, the S&P is down 25 points, down 0.6. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thanks for that, Charlie. You know, we've talked a lot about the one-year anniversary of that Russian invasion of Ukraine. And Carol, I did not know about this until reading this story. But President Vladimir Putin, he begins the war. A network used throughout Europe, including by the Ukrainian military, then faced an unprecedented cyber attack. And it's one that everyone is finally talking about.
Yeah, I feel like it went from no one to everyone, and they should be. This story is coming up in the new issue of Bloomberg Business Week on newsstands tomorrow, already online at Bloomberg.com/businessweek, and of course on the Bloomberg. Let's get to it with Bloomberg News cyber and emerging tech reporter Katrina Manson. She joins us via Zoom in New York City. And of course, we've got the editor of Bloomberg Business Week, Joel Weber, right here in our Bloomberg Interactive Brokers studio. So tell us about this hack.
In my ongoing propaganda for RTO messaging, Katrina and I found ourselves in the Washington, D.C. bureau. And Katrina was like, have you heard of this company, Viasat? And I was like, what are you talking about? She was like, it's a satellite company. I was like, I don't know anything you're talking about. And it turns out that there was a hack at the beginning of the Russian invasion, and no one initially attributed that to Russia. But as the weeks passed and Western governments, finally got around to pointing a finger, they pointed that finger out Russia, which obviously Russia says, we're innocent, we're innocent. But what it really revealed was something that I thought was worthy of further exploration, and Katrina did a great job on this. And it turns out satellites are really unsecure, and that is a little frightening when you think about the amount of data that is sent there. And so this Viasat hack that you read about, Katrina, tell us why it ended up being a much overdue wake-up call for the satellite industry.
Well, I think tracking it down was so fascinating. Reports came out in drips and drabs. There were other journalists who are very obsessed with this issue who were, of course, covering it. But it was very hard to put together the overall picture. And some cybersecurity researchers did incredible work really trying to encourage the company to talk about this in public. And when I say cybersecurity researchers, I mean hackers. They have been trying to hack space for a decade plus for white hat reasons. That's classically known as for good, to share that information so other people improve. But it's a really sensitive area. And so one of the main people I spoke to for this story, Ruben Santamata, he's been warning since 2014 that space is insecure. And he said to me that page 10 and 11 of one of these very esoteric papers that he'd written actually essentially predicted exactly what happened to the Ukrainian military, which relies on commercial satellite in remote places to get their internet connections. That's essentially how they want to link frontline troops to command and control, to controlling drones, all the things that you would need to respond to a very swift, or what was intended to be a very swift lightning invasion by the Russians. So the stakes were incredibly high, and it came down to a lot of researchers who've been clanging the bell for this for so many years. Another one I spoke to, called James Parvell, for the story, he intercepted satellite data transmissions. That's from the satellite down to, in this case, ships that were relying on satellite connections. And he got hold of crew manifests, passport details, credit card details. It is extraordinary how much out there in space is not encrypted and how easy it is to get hold of it.
See, and I was so hoping she was going to talk about Captain Midnight, but we'll get to that later.
I mean, we have to. We have to. I mean, I wonder if you can talk a little bit about the U.S. intelligence on this. The U.S. looks into it, gleans that the Russians were prepared to take significant diplomatic and strategic risks, which feels like something that you could have told us before the U.S. intelligence looked into that, Katrina, but I wonder if you can talk about how much the U.S. knows as we stand today and maybe the extent to which we don't know.
Well, I can tell you what I know, which is definitely not everything. But I think the US worked fairly quickly, within about 4 weeks, to work out that they thought it was the GRU that's responsible. That's Russian military intelligence. They have allegedly done lots of hacking, according to the US, in the past. And what was interesting about that was that it was coordinated with the invasion. Now, once they established that, they then spent 6 weeks trying to convince the Europeans that they were right. And I think it has interesting echoes for the rest of how the US approached the Ukraine invasion, which was to flag early on to the Europeans, look, this is going to happen. We have the intel. And the Europeans, namely the French and Germans, said, no, we don't think so. And in the case of the satellite hack, the US actually went above and beyond and shared additional intel, I'm told, by a European official, with the French and the Germans to try and convince them not only that this had happened, but that it was really important to blame Russia in public. Yeah. And that's something countries simply don't usually do.
Well, as you say at the end of the story, you have a quote from a source who says it is super, super repeatable. So that's distressing.
I was going to say the good news is that this will never happen again, right, Katrina?
I may well be invited back, I'm sorry to say.
So walk us through what has to happen in order for this to not happen again.
I think at the most extreme end, some groups in the US are calling to make space systems a critical infrastructure sector. I mean, that is terrible jargon. I'm sorry to even introduce it, but it's essentially to say, give this sector way more prominence, government support, and essentially potentially regulation. That's something satellite companies mostly don't want. And I think the US government isn't going to do that. It would require Congress to step in. It's part of a 5-year review. I mean, it's just going to get sucked into all sorts of, bogged down into stuff. But the easiest thing to do is to set standards. And that's actually what the source who said this is super, super repeatable is doing. He wants international countries to agree, well, how do we run our satellite systems? What do we do with the satellite up in space? How do we control the link? What goes into the ground network? And as you have more and more satellites going up into space, I mean, the numbers are, can I say astronomical?
This is the best part. Yeah. What do these numbers look like?
Yeah, I mean, it's from about 5,000 active satellites in orbit at the moment to within the next 7 years, the high-end predictions are 100,000. That's because satellites are getting smaller, launch is getting easier, everyone's into this new low Earth orbit, which is much closer, so easier to get to. The satellite that got hacked was a geostationary satellite, way higher. So you're going to see way more satellites in, which means that if one gets hacked, there are others you can rely on. But I think what's key is establishing standards and working out what goes into that glue and protecting ground networks. I mean, that's actually what the entry was in this hack. And there are really convoluted chains between the different operators of a satellite network. And it seems that the ball got dropped in that case. There was a third-party operator. Right. That's whose network was reached, and it went all the way to Viasat.
It's our new kind of warfare, right? Cyber warfare. And like you think about nuclear deterrence, like how we create that kind of deterrence when it comes to global satellites. Incredible story. Katrina Manson, cyber and emerging tech reporter at Bloomberg News via Zoom. Jill Weber, editor of Bloomberg Business Week. This story in the new issue of Bloomberg Business Week magazine.
company news headlines on Bloomberg Radio.
It's 2:53 on Wall Street from Bloomberg World Headquarters. I'm Charlie Pellet. Rivian shares are trading lower after the electric vehicle maker's 2023 production forecast missed the average analyst estimate. Several analysts have lowered their price target on the EV startup following the results, with Wells Fargo saying the company's cash burn is a growing concern. Rivian right now is down 19.35%. Shares of peers Lucid and Fisker are lower as well. Right now, Lucid is down 7.2%, Fisker down 4.5%. Tesla, holding its investor day today, Tesla is down now by 1.7%. Goldman Sachs shares are trading lower a day after its investor day. Devin Ryan is director of financial technology research at JMP Securities. He has got a market outperform rating on the stock.
You know, the turnover there is at a low since 2014, and their employee turnover is at a 5-year low. So they're not seeing a mass exodus in any way. And, you know, again, their book value's grown almost 40% since their last investor day, and the stock has outperformed the S&P by more than 2x since that day. So I think they deserve a little bit of a pass here, and I do think they're executing, just not hitting on all cylinders.
And Goldman down now by about 0.7%. Kohl's reported fourth quarter sales this morning that did fall short of analyst estimates. It also issued a downbeat forecast for the full year. Kohl's shares now down by 2.9%. And those are the company stories we're following at this hour. I'm Charlie Pelletin. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
I'm Mads Mills here with Carol Masser. We're going to have more Business Week to come for you. But first, let's get a check on world and national news with Nancy Lyons in D.C. Hey, Nance.
Thanks, Madison. President Biden says it's a big deal. Eli Lilly is capping the price of insulin at $35 a month. Bloomberg's Nathan Hager with the latest.
The president put out a statement saying it's flat wrong that many Americans with diabetes pay more than $300 for insulin, even though it costs less than $10 to make. He's urging other drug makers to follow Lilly's lead and put their own caps on insulin prices. Lilly cut the list price for its generic insulin Lispro injection to $25 a vial. Other doses sold as Humalog and Humulin will be slashed by 70% in the fourth quarter. In Washington, I'm Nathan Hager, Bloomberg Radio.
U.S. intelligence agencies say they can find no indication that a foreign adversary is behind the so-called Havana syndrome that's caused brain injury and other symptoms in American personnel around the world. The findings of an investigation into the cause cast some doubt on the long-standing suspicion Russia or another country may have been running a global campaign to harass or attack Americans using some form of directed energy. Attorney General Merrick Garland today has been giving an annual briefing to the Senate Judiciary Committee. Republicans demanded more information about investigations now being led by separate special counsels and wanted to know about the probe into Hunter Biden, President Biden's son.
I have pledged not to interfere with that investigation, and I have carried through on my pledge.
Garland also came under attack from Republican Senator Ted Cruz, who accused the Attorney General of ignoring threats against Supreme Court justices following the overturning of Roe v. Wade. In northeastern Greece, at least 38 people have been killed, 72 others injured in a train crash. Authorities say a passenger train collided with a freight train just before midnight and then started a fire. In response to the accident, Greece's infrastructure and transportation minister resigned today. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Madison and Carol.
All right, Nance, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Even if your small business only had minor setbacks during the pandemic, you could still qualify for a payroll tax refund. Provide the tax experts at Innovation Refunds with some basic information and then let them calculate the amount you are eligible for. If you want to learn more, just head to getrefunds.com. All right, in just a few minutes, we're going to head over to our TV colleagues, talk a little bit about the trade. In the meantime, a couple stories on our radar. Michael Burry, very known to our audience, famous for betting against the housing market before the 2008 crash. He now is talking about student loan forgiveness.
Yeah, he predicts terrible consequences if student loans are forgiven. Again, this is the 2008 housing crash predictor, so this is a pretty big deal. He tweeted about this saying, "Let's not forget that the student debt problem is built on a foundation of terrible major choices. Bailing generations out of those bad choices will mean more bad choices." What's interesting to me about some of his he loves to tweet these hot takes and then he immediately deletes his Twitter account. He does this like once a day.
What's up with that, right?
So I need him to stay on Twitter so I get his good investor information.
All right, there's that happening on it. And just real quickly, Starbucks office staff slamming the return to office plan, and they apparently put out a letter that was sent to senior executives and board members. We posted on a website, I think it was today already, but they're slamming that return to office plan. They've got a lot of things that they're not happy with.
Yeah, they got a lot going on. Senator Bernie Sanders called a vote on a possible subpoena for Starbucks CEO Howard Schultz today as well. So lots of Starbucks stuff going on.
Well, we know workers have gotten stronger, right? You know, a lot of them are looking to form unions after decades of union representation and empowerment really waning. So it's definitely a different environment. Speaking of environments, Maddie and I are going to head over to our TV colleagues. We're going to talk about the trading environment. We've got some earnings coming up after the close as well. Right now, we're heading over to our TV team because Bloomberg's Countdown to the Close. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session. Romaine Bostic alongside Scarlett Fu. We're joined right now by our colleagues Carol Massar and Madison Mills. Welcome to our audiences across our Bloomberg properties on Bloomberg TV, radio, and originals, as well as for those folks streaming on YouTube. Carol Massar, a lot of concerns right now about inflation and more importantly about, well, the Fed's persistence in fighting that inflation has taken a leg out of stocks, also taken a leg out of treasuries as well.
Yeah, we're going to talk about that treasury trade, right? That 10-year hitting that 4% mark. Having said that, we've gotten a bunch of economic news and inflation news from around the world that is certainly catching our attention. I'm going to focus on China because, once again, we see some outperformance, and this happens as we're seeing outperformance and getting a stronger rebound in the Chinese economy. We got that PMI data. It showed manufacturing posting its biggest improvement in more than a decade. So you have the Golden Dragon China Index. It's up about 3%. You've also got a couple of names that are top in the NASDAQ 100. Pinduoduo is top in the NASDAQ 100. You got JD.com, also top in the NASDAQ 100. Morgan Stanley, by the way, naming it as a catalyst-driven idea ahead of the company's earnings on March 9th. And then Baidu is up more than 4%. By the way, it's unveiling its ChatGPT-like Ernie bot. That's happening on March 16th.
Ernie.
So there's a couple of different things at play. I know it sounds so like Ernie and Bert, like, you know, Sesame Street. I don't know.
Wonderful. I'm looking forward to that. What do you got, Maddie?
I love when we name the robots.
So dismissive.
So you covered China, Carol, beautifully. I might add, we're going to do Europe over here, going global. European inflation obviously popping. We had France and Spain. Today we got Germany. We have Joachim Nagel this morning of the Bundesbank, big part of the ECB, saying to our Maria Tadeo that QT needs to speed up a bit. Quantitative easing expected to begin in June at a slow pace, $15 billion a month in passive roll-off. At that pace, it would take 30 years for the ECB to reduce its $9 trillion balance sheet. We talk a lot about rate hikes. Another question for the ECB, what's going to go on with quantitative tightening, and does that need to speed up as well, Romaine?
That 15 billion euros, everybody keeping an eye on that and saying that is not going to stick. They've got to go a little bit higher than that. You bring it back to the United States market at 39.48 on an S&P 500, not far off the lows of the day. The lows of your day, that actually came within the first half hour of trading where, well, at one point we actually did trade below that, right at that 200-day moving average. A retest of there afoot right now. Dow Jones Industrial Average down about 0.2% in the NASDAQ Composite, and the NASDAQ 100 down about 7 to 8.8% here on the day.
And when you look at the sector performances, it's pretty clear it's to the downside. You have 8 of the 11 sectors in the red. The exceptions here are energy. In fact, 22 out of the 23 members in the S&P 500 Energy Index are rising today. Materials also gaining 0.8%, and industrials also doing better. So a little bit of that cyclical recovery there.
I was looking at some of the gainers, Carol. You kind of touched on some of the Chinese companies getting a bid here on the day. NetEase up about 5% here on the day. And look at First Solar back here in the U.S., up about 14% on the back of its earnings. But I want to focus on one of the worst performing sectors out there on the day, and really over the last few days, and that is in real estate. Vornado, of course, one of the largest owners of Manhattan Street Retail, down about 1% here on the day. In fact, that's a fresh 52-week low. In fact, still camped out. I believe what's still the lowest level that we've seen at least a couple of decades here. I'll double check on that. Blackstone down about 1% here on the day. Another sort of restriction being put in place on investors pulling money out of that B-REIT product. Of course, we've talked a lot about that. B-REIT primarily focused in on a lot of the residential sector, apartment buildings, student housing, and the such here. But it is raising a lot of concerns about the broader real estate space. And there was a great story on the Bloomberg Terminal by Natalie Wong and John Gittleson here about office space, and more importantly, about that $92 billion of non-bank office debt that's coming due this year. You take a look at that chart on your screen. It is a massive differential between what's coming due this year and next year versus what's out further out. And the big question is, how do you refinance that debt in a market where we continue to see rates elevated and potentially even going higher? We've already had several anecdotal evidence of some folks just deciding to walk away as a strategic move.
Yeah, it's really tricky, right? It becomes so much more expensive, and that's when you start to see things come undone. Having said that, we want to go to a voice that we've talked about a lot over the past year. We're talking about Morgan Stanley's Mike Wilson, right? #1 in the Institutional Investor Survey for calling the sell-off in stocks early and right when it comes to what happened in the trade last year. Well, he's got another warning for investors. He caught up with our team over on Bloomberg TV, Jonathan Farrow, earlier today. His warning has to do with U.S. corporate earnings. Here's what he had to say.
March can be both seasonally positive or negative, but what we're seeing is this pattern over the last year where, we're in an earnings downtrend. And there's a presumption now, I think, by the market that because the economic data has been a little bit better than expected, including what we were expecting, that the earnings declines are now over. And that's not what we think. Some people think the worst is behind us. We think the worst is still probably ahead for most companies.
All right, that is, of course, Morgan Stanley Chief U.S. Equity Strategist Mike Wilson earlier on Bloomberg TV. What's interesting, too, and he was talking about this in the context of those strong Chinese growth numbers, Maddie, that we got overnight, and saying, listen, this isn't a global growth story. This is a China growth story. And if you look at U.S. equities, a lot of them aren't going to benefit by what happens in terms of Chinese growth. That's what he had to say earlier today.
Well, it's so interesting when we talk about the China growth story, because Bloomberg economists are predicting that it may be hard to retain that growth. It's going to continue into the second quarter, but it might start to ease off after that pent-up demand wanes a little bit. But Scarlett, I wonder how much of that consumer demand is going to wane, given how long we've seen that consumer resilience here in the U.S.
Consumer resilience in the U.S., although it all depends on the job market and how resilient that can stay in place. I want to go back to the earnings issue here that Mike Wilson brought up, because there's a lot of questions about earnings quality. And Romaine, I know you read this story too by Lou Wang of Bloomberg News, talking about this increase in cashless earnings, where a lot of the profit is accounting, where people are putting it down as income, but it's actually just revenue that has not yet been recognized because it has been paid over yet.
Yeah, and I thought the data she had in there, which we have to credit to UBS, but there's just showing the differential between actual earnings growth versus the actual cash flow growth, and that divergence, a divergence you don't necessarily want to see, because at some point that has to be reconciled either to the upside or to the downside. I think when you talk about earnings quality and sort of what we've heard out of the past earnings season, at least here in the U.S., I mean, just look at some of the earnings we got over the last 24 hours out of Lowe's and some of the other retailers here. I think it's very indicative of that, and we get some more later after the bell.
Yeah, the devil in the details when it comes
and tomorrow,
to
Macy's
earnings
and
quality.
All the big department stores.
Absolutely, tells us so much about the economy
You're
and the consumer.
You're a shopper, right?
I think we're all shoppers. Come on.
Oh yeah,
this is the U.S. economy we're talking about here.
No, I'm paying for a college education. I have no discretionary income left. All right, guys, we're going to be back in less than an hour's time. We're going to continue our coverage on the markets and some earnings after the close as well, including Salesforce. Back on radio, TV, and on YouTube, and of course on Bloomberg Originals. We'll see you at 4 p.m. Wall Street time for Beyond the Bell.
You want something, you need something.
All right, everybody. We're going to continue with our TV team because we are talking so much about Fed policy, inflation, economic news, what it means for valuations in the marketplace. But one of the big things we talk a lot about is whether or not, right, Maddie, the Fed can engineer a soft landing.
And one big factor in the soft landing, which is one of the many buzz phrases, I should say, that we talk about here is whether or not they can control potential wage price spiral. And this is a really cool story that you and I both love, Carol, from Bloomberg News economics reporter Rich Miller. He's going to join us to talk about it on Zoom from our Washington, D.C. bureau. Rich, we talk about the wage price spiral. Your report is about a reverse wage price spiral. Tell us what exactly that is.
Yeah, it does sound like does sound a little weird. Basically, what it is that a lot of the increase in wages that we saw about a year ago was due to workers trying to catch up to inflation, and now that inflation is coming down, wage demand should come down, and once wage demands come down, means companies are paying out less wages, so therefore they don't have to raise prices that much. So you get a sort of virtuous cycle of the reverse wage price spiral, as opposed to the one the Fed's always worried about, which is where higher inflation leads to more wage increases, leads to higher inflation, et cetera, et cetera.
All right, how do you think about this? I mean, is this just another reminder, Rich, that we are living in wacky times in terms of how the cycle works out or doesn't?
Yeah, that's a good way of putting it. David Wilcox, who's an economist with a former Fed, very senior Fed economist who now works with Bloomberg Economics, said, described this as yet one more mystery of the post-pandemic era. Just put it up against all the other ones. I mean, and as he said, we still don't know for sure, and there are some big-time economists, including Jason Furman and Larry Summers, both at Harvard and both former policymakers in Democratic administrations who are skeptical of this. So it's still a debate. And actually, somebody who is in the White House right now, Jared Bernstein, called it a legitimate head scratcher that we really don't know. But it could work out the Fed's way, and
well, but having said
all
that,
of our
Rich,
way.
I mean, wages are still, though, inflated, right, and elevated. So we're not quite there yet.
No,
and I guess,
for sure.
And anything I would say is, just when we think we figured it out, a data point or a series of data points come out, and they're like, "Hey, guys, you don't have it right."
Yeah, no, for sure. Or the previous data gets revised, and what we thought was true was not true. I mean, if you look at average hourly earnings, which is probably the easiest way to look at it, they were running at a 5.9% year-on-year clip last March, and in January, the last data that we have, it was 4.4. But you're right, that's still too hot for the Feds. The Fed would probably run it the wages rate rising more at something at 3 to 3.5 rather than 4.5. So it's still too hot for the Fed, and it's still why most people think that the Fed's going to raise rates at least a couple more times to try to get on top of this. But arguably that trend is moving in the direction the Fed wants to.
So what causes a reverse wage price spiral? Because if we kind of go through the timeline a little bit, there was the pandemic, the labor shortage, the workers had the power to kind of name their price to come back to work. What shifts that? Okay, so
it's basically like we had a surge in inflation, right, coming out of the pandemic because of the supply shortages and because of the Russia's invasion of Ukraine. So you had a big spike in inflation and gasoline, food, everything basically, right? So I'm a worker and I'm in a pretty tight jobs market, and I see that and I say, wow, inflation is 9%. I go to my employer and say, man, you got to at least give me 9%.
Yeah.
But now, the supply chains are slowly getting back to normal. The gasoline prices have come down a lot. Food prices are still high. So I'm a worker now, and I go to my employer, and inflation is 6%. And I say, well, okay, give me 6% instead of 10%. And then because I'm asking for less, he doesn't feel as much of a need to raise prices. So hopefully inflation goes down a little bit more the next time I'm asking for a wage increase. That's the mechanism. Like I said, there's a lot of controversy about that's how it's going to work, but at least it seems to fit with the facts so far.
I'm amazed that the workers who are going into a room with their bosses and asking for a raise are this impacted by the percentage that we put on CPI data or the inflation data that we get. In your reporting,
you don't think that the big difference is like, if prices are rising 10% or if prices are rising 6%, that would affect how people think about how much money they want?
All I can say is I know I don't think I'm telling on anyone, but some of the conversations, I mean, we talk about this for a job, but the conversations in the newsroom, as we've all been going through our annual reviews and stuff, it's like, hey, we talk about this inflation number every day.
Right. Well, also, my friends are like, I want the most amount of money you can offer me at all times. So that if disinflation is happening, it's not necessarily changing that conversation for them. But what do you think about that?
That's fair.
I mean, I don't know. I mean, as you say, we're all going through our evaluations. Probably there's a lot of other employees going through their evaluations now. I mean, if I look at how much Bloomberg is offering me or saying to me, and it's say it's 4%, say, and inflation is 10%, I get a lot more pissed off. Pardon my French. Than if inflation is 6%, right? So I mean.
Yeah.
There is a difference, I think. I think it's a difference in how much, and people, you don't always go in for how much you think you can get because you're afraid that then the reaction might be, well, we can't pay you that. Goodbye, right? I mean, it's a bargain. I mean, it's like, we all want to get as much as we can, but there's a trade-offs that
of course.
Yeah,
people, and I do feel like people have become much more savvy, and certainly, whether it's stuff in the news, I felt like we came off the financial crisis a little bit more savvy about certain things, or the real estate crisis, and I do feel like folks like, what we do, and we talk about this incessantly because it is kind of the only game in town, what's going on with inflation and the pressures it puts on it, that it becomes part of kind of our normal speak and our walk of life. Having said that, one of the things I do think about, Rich, is that speaking of talk and a way of life, and sentiment is so important to what happens in markets. And I do wonder if there is a point where workers are listening to all of the recession talk, and we've had a lot of headlines with tech layoffs and so on, that even though we know it's still a tight labor market, do workers start to back off a little bit because they're like, all I know is I still want a job?
There is some data, but it's not very definitive, but some surveys which show that workers are, when they ask to rank, what's important to them, that job security has moved up since over the last year. It's not moved up a lot, but that sort of speaks to what you're talking about, right? That people feel a little more uneasy, and as you see, it seems like everybody's talking about recession, right? People feel a little more uneasy, and so as you guys said before, I want to get everything I deserve or more. But if job security, if suddenly I feel, my job might not be that secure, then I might not press so much on the wages. And there is a little sign in the data, but it's not very definitive that job security is becoming more of an issue. Workers are putting that higher in their priority. Higher in their priorities.
Hey, Rich, just got about 40 seconds. Last question. I have to say, when we first saw your story, and certainly when I first saw your story, one of the things that I'm almost thinking, my God, is the Fed and Jay Powell going to be able to really actually engineer that soft landing, something we've talked about for so long, and like, no, it can't happen. But your story makes me wonder, like, maybe it can happen. Just got about 30, 35 seconds.
Yeah, I mean, I think, most economists would bet against it, but it's certainly sort of still a possibility. I mean, I would think, it's most economists would say it's not more than 50%, but they'd probably still say it's 30 or 40%. That's still, pretty substantial, especially when you're trying to figure out what to do in the financial markets, et cetera.
It's just pretty wild. I can't wait to see kind of the economic books written about this era because it just really keeps all of us on our toes, which is why we appreciate, Rich, all of your reporting. Rich Miller with us. He's economics reporter at Bloomberg News, has seen a lot of cycles, understands different Fed policies. So glad we could check in with him, joining us via Zoom from our Washington, D.C. bureau. It's just fascinating times.
It's so interesting to think about what impacts the consumer more, like the lived experience, gas prices easing, or just hearing headlines about the recession.
No, you're right. And different age groups, right, thinking different ways about when it comes to what you're paid and just kind of living in this economy. All right, we are definitely living in this economy. Carol Master, Maddie Mills, right here on Bloomberg Radio.
headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We check markets all day long here at Bloomberg. Stocks lower across the board. The Dow, the S&P, NASDAQ, all in the red. Let's head right over to the first word breaking news desk for today's afternoon call. And here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks trading in the red today as the S&P 500 tests the 200-day moving average. Dow's currently down 47 points. S&P's dropped 20, and NASDAQ is lower by 80. The U.S. 10-year yield hits 4%. That's the highest since November. Gold is up 10. Energy is climbing, and Bitcoin is higher by 1%. Of the main 11 SB sectors, leaders were energy and materials. Utilities were under pressure. And leaders to the upside on the Dow, Caterpillar and 3M, while Home Depot fell 2.3% and led to the downside. After earnings, Lowe's fell 7%. That's the biggest drop since 2020. And in other news, the Tesla Investor Day starts at 4 p.m. Wrapping things up, Salesforce and Snowflake report after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. We'll be all over those numbers as they break into here live. Breaking news over your Bloomberg. Type Squawk SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Maddie Mills, live in our Bloomberg Interactive Brokers studio right here on Bloomberg Business Week. We're also on YouTube and on Bloomberg Originals. Maddie, we're going to get to another story that is among the most read on the Bloomberg, and it's certainly something we've touched on before, and that is worrisome when it comes to looking at the consumer debt picture here in the United States.
Yeah, Carol, we're talking about car debt, and it is a huge problem piling up for a lot of consumers across the country. So here to tell us more about it and her reporting on this issue is Bloomberg News consumer finance reporter Paige Smith from our Bloomberg 99.1 studio in D.C. Paige, thank you so much for being back with us. What's going on here with this just exponential car debt?
Thanks for having me, folks. Nice to be back. So it is sort of a number of factors. I mean, when you consider there was sort of a lull during the pandemic. I mean, I don't know about you, but I heard of friends turning in their Subarus and getting more back than they'd paid for them. But that phenomena is gone now, and basically, negative equity or essentially owing, the debt exceeding the value of your vehicle is not an uncommon occurrence. It's quite common, in fact, but we spoke with dealers who were seeing consumers come onto their lots with $10,000 in negative equity or even more for that matter. So gone are the days when you could get more for your vehicle than you paid for it. Factor in there are a number of other factors like high interest rates to consider now. So this is it's a tough time for consumers and for folks who have auto loans in particular.
It's a really tough time, partially because of those high interest rates, but also in the story you mentioned that the initial cost of the car is already too high for a lot of people.
Exactly. And when you think about it, so you have, a car that might be $50,000 or $60,000, and then you have in January, for example, the new car interest rate was 6.9%, and you have a loan for maybe 7 years. That's a lot that you're paying at the end of the day. We have, a number of consumers are paying more than $1,000 a month for their car. If you think about it, that's more than some people pay for rent every month. So it's really expensive out there, folks.
What's really, it's like heartbreaking. Yeah. But you talk about negative equity. It's never good, but it's somewhat unusual or not among car owners, right? We see this. What's different right now, Paige, right? Is it just kind of the size and scope that we're seeing?
Exactly. I mean, you have folks who were kind of, maybe wanting to buy a car, and if you have a car that lasted you through the pandemic, but now you're going to look for a new car, it's extremely expensive. And yes, the loan terms are longer, interest rates are higher now. You're seeing, the rate of severely delinquent loans hit the highest level since 2006. I mean, it's just a lot to think about as a consumer, and it's overall really expensive.
And they're also struggling to get any type of refinancing, right?
Exactly. I would say that, folks, we've already seen lenders kind of tighten their standards. So, if you want to go out and get any sort of an auto loan, it might be harder for you to do so these days.
I wonder, makes me think about different things that have come before regulators in the past, whether it's student loans and the amount of debt there and how that has become problematic for so many to manage, especially as we look right now, right, the Supreme Court considering the President Biden's plans to forgive a lot of debt. So I do wonder, can you tell us a bit more about how many of Americans are potentially in trouble or underwater at this point? Are we talking about 40% of car loans? I'm just curious if we have any idea a little bit more into terms of how big a problem this could potentially be.
I don't have that data right off the top of my head, but I know that almost 16% almost 16% of consumers surveyed in a recent poll were paying more than $1,000 a month on their car payments, and I think that for the average, for the number of trade-ins that had negative equity associated with them, it was reaching like an average of $5,500. So, it's like rolling that sum from one vehicle over into the next. And then we're hearing about folks who might even roll that debt into a third vehicle. So to speak to regulators too, you hinted at that. This is definitely on the radar of the Consumer Financial Protection Bureau. They're collecting data on this, and they're going to be watching closely, and so are we.
Paige, that piece for the CFPB is kind of what I was thinking about, because earlier today, I know you were on the close with Scarlett, and I was telling her that I see these hot takes on social media all the time of people saying that the car delinquencies are going to be the new housing crisis. And she was saying to me, well, usually you can kind of bet on people repaying their car payment more consistently than their house payment, because you need the car to get to work. And I know that some of your sources said that as well, that, even if your car is more expensive than a house, to keep your job, which is your source of income, you've got to keep that car at play.
Definitely, and I'm based in DC. You folks are in New York. It's easier for us to jump on a train or jump on a bus. The vast majority of Americans don't have that opportunity. A car is extremely important to get from point A to point B, to buy groceries, to pick up your kids. And on top of that, this is, was a really awful saying, but during the financial crisis in 2008, there were even some folks saying that they could live in their car, and it's just, these are sort of the struggles that consumers are facing and considering when these payments are getting so high.
There's also like this whole idea, like if the debt comes undone, who's responsible for it, right, on the financial side of things. Having said that, the lenders of auto loans, those companies that actually do the lending, what are they doing to help consumers? Because I think you guys include in the story, you include about how they're extending some of the life of auto loans. So just talk to us a little bit about that and what they're doing.
Yeah, so it's sort of a double-edged sword, I would say, because certainly the auto loans are being extended, which means that as a consumer, your monthly payment might not be as expensive, but at the end of the day, when you pay off that car, you will have paid much more than if you had, showed up at that dealership with a check in your hand or had paid just straight cash. So that's why I say it's sort of a double-edged sword. Your monthly payment might be less, but in the end, you are still inevitably paying more.
I know, the longer duration, right, when they...
That's tough. That's tough. It reminds me so much of the student loan conversation. Right now, Paige, your headline is car debt piling up with more buyers, $10,000 underwater on loans. I know it's hard to put a number on it, but 6 months from now, a year from now, how big do we know that number could get? And how big is the shoe going to be that drops on this?
Gosh, I am scared to put a sort of number on that right now, but I will just reiterate that this is definitely on the radar of auto industry folks. Dealers are watching this really closely. The CFPB is watching this really closely. Like I said, the average trade-in for trade-ins with negative equity, that average is around $5,500 right now. But as I said, the dealers are seeing, folks come onto their lots with as much as $10,000 negative equity. So we could see it expand. Hopefully it maybe doesn't, or maybe not hopefully, but we are, it's sort of a wait and see game, I would say at this point.
Yeah, and you do wonder, like, if you need a car, can you put it off and say, I'm just going to live with the older car or whatever, and and deal with it and just kind of hopefully ride it out. I'm blown away by the average new car interest rate, 6.9% in January for 4.3% a year earlier. I think the cars that I've bought over the last 10, 20 years, it was like no
interest rates. Yeah.
Kind of giving you the car away, it felt like. Paige, thank you so much. Really appreciate it. Paige Smith, consumer finance reporter at Bloomberg News, there in our 99.1 studio in Washington, D.C. But it's just another reminder, Maddie, that low rate environment, that was the unusual era. That's not normal. And so this is that reset we're seeing as we come off of that, very inexpensive, cheap, no-cost money that was with us for so long.
Yeah, it feels like people really got used to that idea of every 2 years I can get a new car, and now that is just absolutely not the case anymore for a lot of folks.
Right, you're getting hit on both ends, right?
Yeah.
The cost of cars have gone up, and
the
then
rates.
And the rates are higher as
Yeah.
well. All right, you're listening and watching Bloomberg Business Week. Carol Massar along with Maddie Mills, watching stocks bounce around. We're still low, though, lower across the board on those major equity averages.
All right, well, we're going to keep talking about the markets today, but first, let's get a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Hey, Madison. Attorney General Merrick Garland has been facing questions today from members of the Senate Judiciary Committee. He addressed the January 6th Capitol riot and told them the Justice Department will hold all rioters accountable.
We are securing convictions for a wide range of criminal conduct related to the January 6th attack on the Capitol. We are disrupting, investigating, and prosecuting violence and threats of violence, targeting those who serve the public.
Garland says the department is also making safe policing and voting rights top priorities. Ohio's senators are introducing a bill in response to the toxic train derailment in East Palestine, Ohio. It would create new safety requirements for all trains carrying hazardous materials, including sensors to prevent wheel-bearing failures. Senator J.D. Vance says rail companies must be held responsible.
When these train companies cause these problems, it's really little more than a slap on the wrist. So we actually would increase the penalties, make it so that if a train company causes what happened in East Palestine, they actually suffer some real consequences.
Vance says the bill also requires railroads to operate with crews of 2 or more. An arrest has been made after what's likely to be the worst rail disaster in Greece's history. At least 38 people are dead, dozens of others injured after a passenger train ran head-on into a cargo train and burst into flames. Bloomberg's Sotiris Nikos reports the death toll may rise.
The first 2 carriages in the train are pretty much have been melted. So you get the picture that everyone in these 2 carriages most likely are dead.
Bloomberg's Sotiris Nikos in Athens. The investigation is just getting started, but police have arrested a station master in the city of Larissa near the crash scene. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
Developments, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:41 on Wall Street. I'm Charlie Pellet. We check the markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ 100 index all in the red. 19 minutes to go ahead of the closing bell. Stocks and bonds are dropping as investors calibrate their wagers on peak rates after economic data highlighted persistent inflationary pressures and Fed officials continue to sound hawkish. As for the economic outlook and interest rates, Subhana Rajappa is head of U.S. rate strategy at Societe Generale.
But broadly speaking, I think the momentum, coming from the fourth quarter, you're looking at first quarter GDP in the U.S. tracking, quite strongly. So in this sort of context, at least over the near term, the market's willing to give into the data and start to price in more hikes from both the Fed as well as the ECB.
And right now we have got stocks lower across the board. S&P 500 index down 18 now, a drop of about 0.5%. The Dow is down 5 points, little change now, down less than 0.1%. NASDAQ down 79, drop there of 0.7%. 10-year yield 4.00%. We have got the 2-year 4.89%. Spot gold up $10 the ounce, up 0.6%. West Texas Intermediate crude up 1% now, $77.79 a barrel. Toronto Dominion's $13.4 billion acquisition of First Horizon Corp may be delayed even more than the Canadian lender projected last month. Shares of TD, Toronto Dominion, down by about 0.2%, but shares of First Horizon Corp, they are now trading lower by 12%. Recapping, stocks lower, S&P down 0.5. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Bloomberg Business Week brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. There's more pandemic relief available to claim for small and medium-sized businesses. The ERC is a refundable payroll tax credit your business may qualify for, even if it already received PPP. Let the tax professionals at Innovation Refunds show you how to get the money your business may be eligible to receive with no upfront costs. For more information, go to getrefunds.com.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, folks, just about 17 minutes left in today's trading session. First trading session in the month of March. Stocks bouncing around here, but we've been talking about it, Maddie, all day. Really key. We got it early this morning. We had that 10-year hitting 4%. So watching that Treasury trade.
It's really critical to watch that, and we are going to get to that and all of the macro headwinds facing us with Leo Kelly, founder and CEO at Verdance Capital Advisors, back with us in our Bloomberg Interactive Brokers studio. Leo, great to meet you for the first time, and great to have you here with us. What's the vibe right now? Are you on a vibe session thought? Are you on a soft landing thought? What are you thinking?
Not on a soft landing thought. I think the market has, I'm on a unrealistic expectations vibe.
Okay.
I think what we're seeing in the marketplace is there's a lot of wishful thinking. There's folks that just want it to go back to the way it was, right? And that's natural with investors. They just want it to be good again, and they close their eyes and they hope and pray.
Do you tell them that markets don't always go up?
They don't always go up.
You don't always make money in the market?
And you have to define the market, right? Everybody wants the growth market to return, and they want low interest rates. I think people have to get their head around the fact that we're in the midst of a secular change, a multi-decade change that is going to change the markets. And so I think inflation is higher for longer than people expect. Interest rates will be going up. By the way, the last secular interest rate move was 40 years. The one before that, 40 years. These are not short in nature. So I think we have to start rethinking how we look at markets.
What's the reason for this thought for you in terms of what happens with inflation staying higher for longer?
Yeah, that one's easy. So in the last 10, 15 years, probably since I've been coming on the show, the Federal Reserve's balance sheet's gone from $400 billion to $8 trillion. We spent $2 trillion in fiscal spending in the financial crisis. We spent $5 trillion in COVID. We grew M2, money supply, 40% in 2 years. There's just so much money. And by the way, that's just the US. Every other country in the world did it alongside of us. So there's just so much capital in the system that fundamentally, I just don't see how people think inflation is going to go back to 2. It's going to be a low interest rate environment until we start to reduce money supply. And everybody's excited that M2 flattened this year.
Right.
We're not even going back down yet.
One thing I want to ask you is also the reasons inflation will stay higher for longer, or maybe it's just a new higher level forever because things are changing in terms of demographics, aging populations. We're talking about the regulatory environment as we move towards a greener world. The pushback on globalization. We had guests, and we've had several guests over the last few weeks, just talking about, things are changing. We talked about with our Mark Gurman about Apple, suppliers, they're moving out of China. There are some really dramatic shifts also going on beyond the amount of money that's been sloshing around in the global economy.
100%. So thematically, one of the things that we're talking about, and it's good news for the recovery of the economy on the backside of all of this, is not just rebuilding the supply chain, but reimagining the supply chain, right? There's going to be a lot of economic activity around that. But again, the deglobalization is deflationary. I think the question you should be asking yourself is the anomaly that inflation is going to be higher going forward, or did we just have the anomaly?
Really?
Right. I think the anomaly was below average inflation, below average volatility. A Fed who had a third mandate of protecting asset prices at all costs. That's not how it's been historically. I think we are leaving a moment, not going into a moment.
Agreed. That the low rate environment, the zero, the negative rates, that, folks, was abnormal. And not historically what we've seen.
We had $18 trillion of negative yielding debt at its peak.
Yeah.
Today we have 0.
I guess I wonder about...
Which is unbelievable.
Unbelievable.
It's crazy.
Yeah.
It's crazy. But I wonder about the stimulus piece. You were talking about the amount of money spent during COVID, but that was 2 years ago when Biden had this stimulus package and people got that extra cash in the bank. Why aren't we feeling the consumer pain a little bit more right now and seeing spending drop a little bit more?
Yeah, there's a couple reasons. One, some of this fiscal is still in the system. So, for example, the student debt relief is just now getting to the Supreme Court, and the deferral payments are going to hit now. And so that pain won't be felt until probably this summer or this fall. So there's a lot of deferral of a lot of these programs. We also have to look at the job market. The job market's very tight. There's a mismatch of skill versus job opening. There's more openings than there are people looking for work. And so I think if there is a good side, and one of the positives of what's happening right now is corporate America, for the first time as long as I can remember, came out of this and they were smart about it.
Yep.
Their balance sheets are in better position. Banks aren't over leveraged. The consumer is still reasonably strong, although credit card debt's rising, right? Delinquencies are starting to rise. This is all normal stuff in economic tough times. But they're stronger than they've ever been at this moment. Okay, so there's some underlying strength. However, the Fed has more work to do, and the Fed will get what it wants. It always does.
Well, what's interesting, and having to that point, we had a crypto collapse.
Right.
We have had some other things kind of pick away, if you will, and yet here we are, and the system is working, and the markets are working, and we've seen liquidity. Having said that, though, just to end, because we only have about 30 seconds, you are in a large cash position right now.
Yes.
How large? Can you give us some little skies and scopes?
Well, so for every client it's different, but think about it this way. We're about 3 to 4 times our normal cash holding. It's nice that cash is no longer a cement block chained to our ankle, in the water. We're actually getting a yield, so it's helping us a little bit with return.
Right?
But I think people have to be aware. Volatility is back. It's going to be part of the game. And so having cash around on a regular basis is a good thing so that you can take advantage when these volatile moments peak up.
Because you will put it to work at some point.
We will put it to work when the valuations are attractive.
All right, got to run. So good to have you in studio.
It's great to be here. Thanks for having me. I really appreciate it.
Love it. Leo Kelly, founder and CEO of Verdance Capital Advisors, here in our Bloomberg Interactive Brokers studio. Just about 10 minutes left in this trading session. This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got the Dow higher, S&P, NASDAQ, both lower as we head toward the closing bell. Rivian shares, they are selling off. Rivian plunging 18.5% after the electric vehicle maker's 2023 production forecast missed the average analyst estimate. Several analysts have lowered their price target on the EV startup following the results, with Wells Fargo saying the company's cash burn is a growing concern. So again, we have got Rivian down 18.5%. Its peers also lower. Lucid right now is down 5.7%, and Fisker is trading lower by 4%. Tesla holding its investor day today. Tesla down now by 1.2%. The U.S. Postal Service is buying more than 9,000 battery-powered delivery vans made by Ford. And with that story, here's Bloomberg's Denise Pellegrini.
Charlie, this is all part of a $10 billion push to electrify its aging fleet, and the Ford e-Transit battery EVs the Postal Service expects to take delivery of this December. Well, that's part of a plan to electrify 75% of the service trucks over the next 5 years. And in addition to more than 9,000 Ford vans manufactured at a Ford plant in Kansas City, Missouri, the agency also says it is awarding contracts to purchase some 14,000 charging stations. And these contracts mark a big turnaround for the Postal Service. It announced early last year it planned to replace its fleet of red, white, and blue delivery vans with mostly gas-fueled models made by Oshkosh. Charlie.
Denise Pellegrini, Ford up 2%. Those are the company stories we've got this hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody. Carol Master along with Madison Mills, a Bloomberg Quick Take. Just under 5 minutes left in today's trading session. Bouncing around on the equity trade, off our highs and lows of the session. Treasuries, of course, as we just talked about, maybe a new secular market, if you will, as we just talked with Leo Kelly. That 10-year note just below that 4% mark as we speak, but did hit it earlier in today's session. Having said that, if we're not talking about the Fed or inflation or recession or soft landing, you know what we're talking about? We're talking about AI and ChatGPT, Maddie.
Yep, and we've got more ChatGPT news today. Shocking, ChatGPT opens to corporate clients like Instacart and Shopify, among others. Really interesting to see ChatGPT just absolutely breaking so many records, it feels like, in terms of the amount of talking we're doing about it, and the companies working with ChatGPT already. And interesting also coming off of the news that we got yesterday about Instacart doing really well ahead of a potential IPO from them, I think, right? Is that correct?
Yeah, absolutely. Right. Yeah.
Instacart?
Instacart. Yep. We got some more, if you will, in terms of the specifics on the business.
Yeah.
And they are looking to do their IPO. But it's like riding a wave. Why not, right?
I'm fascinated. I'm like, why would I use ChatGPT with my Instacart? I'm sure someone could explain that to me.
I don't know.
I'm just grocery shopping.
They're going to add ChatGPT to its shopping app, blending it with Instacart's own AI and catalog of available products. Customers will be able to ask the app to do things like suggest healthy options for kids, give instructions for how to make great fish tacos, the company said. Shopify will also use a chatbot for its consumer app. When shoppers search for a product, ChatGPT will offer recommendations.
That's cool. Would you take cooking advice from ChatGPT, Carol Master?
I only take cooking advice from my husband, that's it, and my daughter, who both are really good cooks. Having said that, we're going to talk about all of this with Crawford DePret later on. He's from IDC. He's got a new survey out about IT spending, but we're going to ask him about that as well. And this, let's also remind everybody, YouTube adding AI-powered tools for video creators. So there's so much that is going on when it comes to all of this.
The tech, the social media platforms, all of it.
I am a ChatGPT bot as we speak.
Yes.
I could be.
Aren't we all?
One coming to, yeah.
Aren't we all?
It's terrifying. All right. Got a few minutes left in the trading session. We're going to head over to our TV colleagues, talk about the markets, break some earnings after the close. Beyond the Bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Massar and Madison Mills. Welcome to our audiences across all of our properties on Bloomberg Television, Bloomberg Radio, Bloomberg Originals, and for those folks streaming on YouTube. A market off the lows of the day, and S&P still in the red here. Kind of interesting, Carol, to see, though, that a lot of the, I guess, energy names and materials names, some of those cyclical names, still getting bid. Actually, that's your only bright spot here on the day.
Well, I think that's a result of some of that Chinese data, right? You know, we're seeing that economy coming in stronger than expected. PMI data that we got overnight, continuing to see that play. Having said that, what I am focused on kind of obsessively so is that 10-year note. It's back above 4%. We saw that earlier this morning. It had backed off of it a little bit, but back above that level.
Yeah, and what I can't stop thinking about today is the impact of the global moves, like you mentioned, Carol, not just China, but also looking at the inflation story in Europe. First, we got hit with Spain. It was like a little over 6%, not that bad. Then France over 7%, and then today Germany over 9% on that inflation number. Just really seeing that hot inflation data come out of Europe, Scar.
And of course, Carol, you mentioned the move in 10-year treasuries, the yield above 4%. You're also seeing those bond proxies in the equity market be the biggest drags on the S&P 500, whether it's utilities, whether it's real estate investment trusts.
All right, we got a lot to cover here as we get to these closing bells. I have some big earnings after the bell, including out of Salesforce, Splunk, as well as Snowflake, and of course Tesla's Investor Day set to kick off. Full market coverage right here on Bloomberg Television as we get the closing bells in New York. The Dow Jones Industrial Average relatively unchanged on the day. We'll wait for these numbers to settle, but it's basically not going anywhere. The S&P did go somewhere. It was down about 0.5% on the day. A retest of that 200-day moving average. It is going to close above that 200-day moving average, but only by about 10 points or so. NASDAQ Composite down about 0.7%, and the bright spot on the day, Carol Massar, the Russell 2000 higher, but only by about 0.1%.
Yeah, those small caps, interesting to see that outperformance. Having said that, I'm going to go back to the big caps and the S&P 500. Scarlett, you're definitely seeing most names to the downside, 319 to be exact, so definitely more of a risk-off trade, 184 names trading with some gains today.
Yeah, and leading on the downside is actually retailers. When you look at the S&P 500 among 24 industry groups, we got results from Kohl's, which certainly raises concerns about consumers and their particular market of consumers. And utilities and real estate investment trusts, as I mentioned earlier, bond proxies losing ground as well. Energy, materials, your cyclicals, really the holdouts here in terms of gaining and continuing to gain. And Carol, as you mentioned, on that better than expected China data on manufacturing and on services.
But as Mike Wilson said of Morgan Stanley, it's a China growth story, folks. So remember that when you're looking at the U.S. equity trade. Quick to some of the individual gainers today. First Solar, top in the NASDAQ. First number one gainer in the S&P 500, and that stock pretty much holding on to its gains of the day, up just shy of 16%. Earnings last night, fourth quarter results, and 2023 guidance beat expectations, adding more than $2 billion to its market cap today. We talk about, Scarlett mentioned it, I mentioned it, we all did, about China growth, the outperformance that we are starting to see there. So those Chinese names that trade here in the U.S., top in the NASDAQ 100. Pinduoduo, it was, I think, your number one gainer in the NASDAQ 100, up about 3.8% here. So we saw that sector, those Chinese names overall trading higher. And then B&G Foods, up 28% in today's session.
I saw that earlier. That's crazy.
It's Crisco.
Yeah,
it's Green Giant. It's cream of wheat, right? Yeah. Back to nature. They are one of my favorite cookies. Did report fourth quarter adjusted. Yeah, they're like plant-based. They're wonderful.
Okay.
Foodmaker reported fourth quarter adjusted earnings per share was nearly double the average analyst estimate. It's up about 50% year to date, but keep in mind about 17% of the float is shorted, Maddie.
All right, well, you got to talk about the cookie trade, which is very exciting, but I'm going to go on to the Rivian train. Rivian dropping as much as 18% on the close, I believe. Highest drop in 9 months. That comes after 2023 production forecast, of course, missing estimates. They set a target for 50,000 new vehicles this year. The expectation was for over 62,000, and they already missed their target last year. So not a lot of love for that move there. Wells Fargo saying the company's cash burn is a growing concern there. On the topic of EVs, we've got Tesla having their investor day. They're down by 1.4% in the close. Barclays says it may turn into a sell the news event on Tesla. We saw that with Goldman yesterday during their investor day. So those investor days can be tough. And then I got to end on Lowe's. Scarlett, you were mentioning this, these retail consumer companies going down. Lowe's is not the only one. We're seeing lots of shaking conditions in the housing market for some of these retailers and big headwinds for the home improvement space that Lowe's is really feeling. But we've heard this song before during expecting earnings from Walmart, Home Depot, Target, and all of those companies.
Yeah, a lot more earnings out of the retailers tomorrow. Of course, we're going to get Macy's, Nordstrom, and a few others here. Let's move back to the yield space because that is where a lot of the volatility was, a lot of the price action as well. 4.8785 right now on a 2-year yield, up about 6 basis points. At one point, it did trade above 4.9 as it starts to creep higher and higher towards 5%. Meanwhile, that 10-year yield did creep higher towards that 4% level and did trade above it. 3.9945 right now on that number as a lot of people look ahead. Even on the long end of the curve, wasn't spared, up 5 basis points on the 20 in the belly and about 4 basis points, guys, on the 30-year yield.
And we have Okta results that have come out. This is an application software company that reported earnings. It is jumping in the post-market right now after its first quarter adjusted EPS beat analyst estimates. It sees first quarter revenue of $509 to $511 million when analysts were looking for under $500 million. Fourth quarter adjusted EPS for the quarter that ended 30 cents when analysts were looking for 9.1 cents. So a clear beat here as Okta jumps in post-market trading.
And I'm sorry, but I'm curious too. I mean, we talk about business spending and the resiliency of it. I remember when we were headed into this year, there was this idea that even if we head into a recession or an economic doldrum, the idea is that these types of software and software services, companies really couldn't cut back on that. I think some of the earnings we've seen so far out of this group shows that that's not necessarily the case.
We talked with a senior member of the executive committee over at SAP yesterday, and she said what's happening is people are still doing IT spending, but they're looking for value. They're being very smart, and they're bringing often the CFO and finance officials into those decisions to make sure that they're spending on IT in a smart way.
Yeah, and it reminds me of what we're expecting to see from Salesforce later today. Expectations, I should say, that Salesforce is expected to post its slowest ever quarterly
Yeah, let's go straight to
did it just came
Salesforce.
out? All right, Romaine, take it away.
Salesforce earnings crossing the wire right now. Let's take a look at the headline number here on their 4Q sales, $1.8 billion. The street was looking for 1.71 here. Adjusted EPS coming in at $1.68. The street was looking for 84 cents. So a big beat on adjusted EPS, a modest beat on the sales figure here. Interesting, too, we talk about operating margins. There was a lot of concern here about costs and the idea of Mark Benioff and his ability to rein in those costs. Adjusted operating margin coming in at 29.2%. Guys, the street was looking for 22.4%. So it looks like a beat on some of the headline numbers here. Not really seeing a forecast here, but we'll dig a little bit deeper into that as we dig through these numbers.
Also, Snowflake coming out with results as well. And right now, it does look like the stock is moving as well in the after-hours trading. Fourth quarter revenue beat analyst estimates, $589 million. Analysts were looking for $575 million, or just over that amount. In terms of the outlook, first quarter product revenue will be anywhere from $568 million to $573 million. And analysts were looking for $582. So that's where you see the catalyst for the decline there.
Sorry, I just want to jump real quick back to Salesforce because we are getting that forecast going forward. Their 1Q revenue numbers looks like a beat as well. $8.2 billion roughly is the guidance that they're giving. The street was looking for 8 even on an adjusted EPS basis. The range that they're giving is $1.60 to $1.61. The street was looking on average for $1.34. And here's your full year 2024 revenue, $34.5 billion to $34.7 billion. That's just slightly above, Carol, what the street was looking for at 34.
Yeah, the operating margin is key because as we've talked about, what the activists, they've got 5 activists that are pursuing Salesforce at this point, and that's what I'm looking through the press release to look to see if there's any commentary.
Do you think they all talk to each other?
They're having cocktails at night. But what's interesting is they've been pushing to cut costs, and that's where the focus this time around has been on that operating margin to see if they can improve it. I'm looking at the press release. The president and CFO Amy Weaver talking about it's a new day at Salesforce. As we look ahead, I'm excited for the opportunity in front of us as we continue to drive profitable growth. So you do wonder about what the future holds for this company because of those activists.
And just a real quick promo, too. We actually are going to hear from Mark Benioff on Bloomberg Television, I believe around 7:30 p.m. on New York time tonight.
Well said, Romaine. That's really amazing that we get those interviews here at Bloomberg. Also, look at the cash flow for Salesforce. Cash generated from operations, an increase in 41% year over year. That number coming in was $2.79 billion for the fourth quarter.
I'm still focused on the operating margin because, Carol, as you said, that's the one that those activist investors are looking at. 29.2%. Analysts were looking for 22%. I know we're not comparing like with like, but Snowflake came out with its adjusted operating margin For 2024, it sees 6%. That's just to give you a sense of scale there.
No, which is really important, right, to see that. Looking forward to that interview with Benioff and seeing what he has to say, especially when it comes to the activists. All right,
Share
we do have
buyback
Salesforce.
program also boosted $20 billion.
That's pretty substantial,
Yeah,
right? They absolutely always do, which explains maybe some of that kick, or we'll see if it continues to trade higher in the after hours. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals Beyond the Bell. We will see you again, same time, same place tomorrow.
All right, we'll dig a little bit deeper into Salesforce earnings a little bit later. Those shares up 10%, a buyback program announced. And of course, this coming just, well, a day after we had Chevron's Investor Day. Investors seem to be relatively pleased with that. We did see a punch up in the shares a little bit earlier during the cash session. Pleased to say, joining us right now for an interview is the CEO of Chevron, Mike Wirth, standing by right now with our very own Alex Steele. Alex.
Hey, Romaine, thanks a lot. I really appreciate it. Mike, it's always good to see you. Thanks for coming.
It's good to be here, Alex.
It's been too long always. Okay, the buyback. It was juicy. Everyone was excited about the buyback. These are big, big, big numbers. Did the White House call you after that?
Well, the buyback's consistent with our approach for many years. It's our fourth financial priority, and we're hitting on all cylinders.
DC doesn't like it.
Well, we raised our dividend. We're investing to grow. Last year was our largest U.S. production ever. The Permian's going to grow another 10% this year. The balance sheet's very strong, and the cash that we have surplus to that, we've always distributed back to shareholders through a buyback. The company's stronger today than it was just a few years ago, so the numbers are larger, but the approach is very consistent.
So the White House has not called you yet?
I haven't gotten a call.
Okay, I'm just asking. You never know. The other part of that, though, is that a lot of investors would much rather have you buy something than deliver a juicy buyback like this. What do you say to that? Consistently, you're saying no.
Well, just because you can buy something doesn't mean you should buy something. You should buy the right thing at the right time. And I think we've got a track record of well-timed M&A. We were the first one during the downturn in COVID to do a deal with Noble Energy, which has been a very, very good deal. Nice deal with Renewable Energy Group last year. So we've not been reluctant to do acquisitions, but they have to make sense. They have to create value for shareholders. They have to fit with our portfolio. And so we'll continue to be patient.
So I think where it becomes the broader issue then is that everyone's looking for a catalyst. Like, everyone likes your story. All the analysts like your story, but they're all neutral. Well, not all of them, but a lot of them are neutral on the stock. There's no juicy catalyst. There's no extra bump. The stock has not performed in line with Exxon, say, or even BP after its recent announcement a couple weeks ago.
Well, the whole industry is re-rating. This is an industry that for a decade languished relative to the rest of the market. And frankly, over the last couple of years, I think our story's gotten traction with shareholders, and we've performed very well. I see other companies now that are experiencing some of the same kinds of things. The sector as a whole is still undervalued, Alex. Last year, we generated 12% of the cash flow in the S&P 500, yet only represent 5% of the market capitalizations. The multiples and the valuation that's attributed to the strong cash flows in our industry are not yet showing up in stock price. So we're seeing a lot of companies now coming back. Everybody's kind of had their own journey to get where they are, and I think the sector still has a lot of room to improve.
How does Chevron not be boring?
Well, we're predictable. We're doing what we said we would do. Sometimes that's called boring. Sometimes that's called safe, reliable, steady, and predictable. I think we've been consistent. We've been disciplined. We've said what we're going to do. We said we're going to deliver high returns and lower carbon. We have seen returns improve significantly. We laid out a plan to grow free cash flow 10% per year for the next 5 years. Carbon intensity down 30%, and we're distributing cash to shareholders. So we're doing it all.
Do you feel pressure to close the gap with Exxon stock, for example, when you've really outperformed them for so long?
Well, it's a long cycle game. Exxon's had their own journey. We've had our own journey. They're a great company. They're performing very well. They're a worthy rival. I enjoy the partnership we have with them in some places and the competition we have with them elsewhere. And I'm pleased to see them and others in the industry doing well.
What is an environment where you would consider another acquisition? Is it depend on the oil price? Is it dependent on the Permian and peak Permian? Like, what does Mike look at to know whether or not it's time to pull a trigger?
Well, we're constantly looking at companies, and really, the first thing you look at is asset quality. Are these assets we would invest in? Would they make our portfolio stronger? We look at strategic fit. Do they fill any gaps that we might believe that we have? We look at valuation. We look at financials. Are the financials accretive to our base case? And we've got a very strong base case. So you've got to have a deal that really creates value in order to do better than what the steady as she goes case is. And then, of course, you want a company that wants to transact. We don't do hostile transactions. And so you've got to have a counterparty that's ready. So there's a whole confluence of events that have to come together. We're always looking. Sometimes we're actually talking. But when we have something, we'll come and I'll talk to you about it.
Yeah, sure. Is the talking going to happen offshore, or is it going to happen in shale? And I bring that up because there's been a lot of worries about Permian productivity. You seem to say everything is fixed yesterday in the Investor Day. Then there's also worries about offshore ability and offshore growth, because you're not in areas like Guyana off the coast of Brazil. Do you feel pressure in one of those areas?
Well, I'll start with the Permian, where we've got an enormous position. We've got 27 billion barrels of resource. We've got 2 million acres. Most of it has no royalty on it, so it's tremendously positioned and it's highly economic. So we don't need more Permian. We can have better Permian, and we're constantly trading and entering into joint ventures to co-develop areas to make the Permian stronger. But our Permian really doesn't need to be bigger. We've got multiple growth engines. Not only is the Permian delivering growth, our big project in Kazakhstan will begin commissioning and start up later this year, and over the subsequent quarters will deliver significant growth. We have Deepwater Gulf of Mexico projects coming online this year, next year, the year after, that will deliver growth. And then we've got other shale and tight positions that don't get the attention the Permian does, but the DJ Basin in Colorado, the Vaca Muerta in Argentina, the Duvernay in Canada all offer growth opportunities for us. So we've got a diverse portfolio of growth. We don't really have a gap.
So just on Kazakhstan for a second, not to get too nerdy, but yes, that can come to fruition, but doesn't it have a lot of political risk now because the pipeline now runs through Russia? So you may be able to develop the field, and that's great, and maybe that's going to be a cash cow, but then how do you get it out? Don't you have a problem there?
Well, the field today produces around numbers, 700,000 barrels a day. This project will take it up to roughly 1 million barrels a day. And the pipeline through southern Russia is the primary route to market. Last year, there were a couple of issues with that pipeline, but it really impacted our production by less than 10,000 barrels a day. This is a risk that's always existed. There are many partners in the pipeline, from European companies to Kazakh and Russian companies, and it's an issue of constant discussion amongst the partners, the government of Kazakhstan with the government of Russia, and we've seen continued flow and access to markets through it. So it's a risk like any infrastructure that goes through different territories, but it's one that's been managed well.
We're speaking with Mike Wirth, Chevron chairman and CEO for our Bloomberg and radio audiences. So then back to the Permian for a second. Have we learned anything yet about asset life in the Permian? Like, do we know when peak Permian is going to be? You don't want to be bigger, but you want to be better. Is that you guys, or is that the asset life?
Well, as I said, we've got over 2 million acres in the Permian, and we're only in the very early days of developing that. So we've got a lot of running room. 27 billion barrels of resource at last year's production represents 100 years of resource. So peak Permian depends on your portfolio. There are some companies that may have smaller positions or secondary or tertiary positions and have done a lot of drilling. They may be closer to peak. We've got such a large position and so much running room ahead of us.
You can run 100 years with what you guys have?
Well, it's equivalent to 100 years of resource.
Okay.
We produced 700,000 barrels a day last year. We guided to 1 million barrels a day in 2025, which has been our guidance for a number of years. 1.2 million barrels a day later this year, and then a plateau at that level that will hold for many years into the future. So we've got a long future ahead of us in the Permian.
You mentioned cost inflation, problem for everybody. In the Permian in particular, 10 to 15%. If you wanted to produce more today, could you, with that kind of cost inflation and the labor issues?
Our approach is a very disciplined approach to planning our work and then working our plan. So we're bringing roughly 1 rig online each quarter. We want to execute well. So trying to accelerate activity means that you're accelerating permitting and logistics and mobilization of crews. And oftentimes that introduces risk and performance issues. So we really don't have a need to or a desire to deviate from the plan we've laid out. We want to work that methodically, consistently, and deliver high levels of performance.
Let's talk about LNG for a second. You guys have a large exposure to LNG. You're developing options to supply LNG to Europe and to Asia. What are the chances that we're going to be in an oversupplied LNG market now? Because everyone's ramping up their LNG supply. When do you think that could happen?
These projects are complex and difficult to put together. There are a lot of projects on the drawing board right now, and Europe clearly needs alternate sources of gas. So you'll see a number of projects being done. But getting financing for the projects usually requires offtake contracts. Offtake agreements have been slow to come, particularly out of European buyers. And so I think that becomes a bit of a limiting factor on which projects will get done and in what sequence. That said, in commodity markets, supply comes on in big chunks. Demand grows in a linear fashion. So inherent to that is you end up in oversupplied markets at some point in time when a lot of capacity comes online, and then over time, that capacity demand catches up with it and then goes past, and you're in an undersupplied market. So these markets become oversupplied at a point in time. You've got to make investments that are low cost and have a long-term prospect of strong returns.
If you want to arbitrage your overseas LNG portfolio, do you need a U.S. LNG portfolio to do that?
It's nice to have multiple sources of supply, and we've got a big gas business in the U.S., and it's growing, not just
Need to grow it more, though, to really get that arb?
No, our gas business here is growing very rapidly. We've got a big position in the Haynesville. Most of it prices at domestic gas prices, Henry Hub prices in the U.S. We've entered into a couple of offtake agreements to convert that to LNG that we can then move to an international LNG market. So it's really about price exposure and getting some greater coverage in different price markers into our business.
Okay. Let's hit macro for a little bit. I want to ask your take on China. How's China doing? Obviously, the PMI numbers were really strong today. Do you see that consistently happening? Like, is it going to get better and better, or is it choppy?
I think we're going to see pretty steady progress in China. I spoke with the CEOs of some Chinese companies not long ago who have seen the COVID move through their workforces. People are back at work. Factories are humming. Roads are congested again. More flights are being added. So all the leading indicators would suggest that economic activity is picking up, energy demand is picking up, and I think as we get into the middle of this year and certainly into the second half of this year, that demand is likely to tighten markets a little bit.
So to that point, though, your base case is $60 Brent. So what does that then imply? Because based on that, for example, and we don't have a lot of spare capacity necessarily, do you think that that should be higher? Or are you just being super conservative?
The number we lay out in our investor materials, we try to be consistent with prior years, so there's good comparability, and with general views on long-term prices. So that's not necessarily our price assumption. It's a number that we lay out to help analysts do models and maintain some consistency with past guidance.
Okay, so we're talking about the macro environment with Chevron Chairman and CEO Mike Wirth for our Bloomberg TV and radio audiences. So just spare capacity. How much spare capacity is there right now in the world?
The world's pretty tight right now.
Is it? Okay.
Yeah, there's some spare capacity in the Middle East. We saw OPEC pull back here last year and indicate that they intend to kind of maintain that posture through the balance of this year. But markets are pretty tight. We do have Russian barrels still flowing, and I think this is what last year this time. There were concerns that those barrels would really come off the market. The market started to anticipate that and reflect it. In fact, what we've seen is those barrels have been redistributed, not removed, and markets now have settled back into a range where they're not too different than they were a year ago. What is different is we're seeing demand growth in China. We've got recession concerns in the U.S. and in Europe that to some degree offset that. I think as we work our way through that spare capacity becomes pretty important if demand grows the way it could in the second half of this year.
Do you think the U.S. can be a marginal producer still?
I think the U.S., what I see is activity levels in the U.S. are pretty high levels. I mean, there's not a lot of rig capacity left. The service companies are looking for a contract for another rig. We're certainly contracted through the rest of this year as we're adding about one rig each quarter. But I think there are limits to how much additional activity the U.S. could undertake in the short term, and so I really do think that the swing producer is back into the OPEC world.
Interesting. That didn't take very long.
No, it didn't.
Only a couple of years where it was here. Okay, as we finish out, it's hard to talk to an oil and gas company and not talk about the energy transition. And you guys, in your 5-year plan, you outlined investments in renewable biofuels, hydrogen, and carbon capture, and not in wind and solar. What does that mean? Like, what does Chevron see as returns in renewables? Like, are they just bad?
Wind and solar are great technologies. They're an important part of responding to the call for a lower carbon energy system. They're technologies that we don't bring special expertise to, and the returns on them typically have been single-digit returns. Our investors and our company looks for double-digit returns, and we look for things that can leverage our capabilities, our value chains, our customers, and our strengths. And wind and solar really don't fit into that. So we're focused on, as you said, biofuels, hydrogen, carbon capture and storage. We're looking at advanced technologies like geothermal that can leverage some of our strengths. So you've got to pick and choose where you're going to invest and apply your people's capability, and those are the ones where we think we can make a difference.
Do those produce returns yet? And when they do, are we talking like low double digits?
Biofuels certainly deliver returns and cash flow today. Our acquisition of Renewable Energy Group last year is one that we're very pleased with, and we're growing that business. Hydrogen development phase, we've got to build out full value chains on these things. We've got to build out new commercial frameworks to understand with an emitter of carbon, what will they pay to have that carbon captured and stored? How do you divide up the